most people are told, especially the millennial generation, we're told to just put it in the target date funds. So if your retirement date is supposed to be 2055, you put your money in that 2055 target date retirement fund, right? It's so easy. Like, oh, I just have to pick the day I want to retire, and that's it. What's interesting, though, is I ran the numbers. The S&P 500's real return in the last 10 years, and just so you know, the average return that they tell you is different than the actual return of the stock market.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Brenneman, and this is the Brenneman Blueprint.
Welcome to the Brenneman Blueprint. Really excited for today's episode. Have guest Chris Miles from Money Ripples. So he's basically like a repented financial advisor. Really interesting story. And one thing, that I really like about Chris, he doesn't just talk about, stocks and bonds and kind of the usual stuff with his clients. And he's also got a really great podcast. Everybody should check out the Money Ripples podcast. And he's also been just kind of featured, it seems like everywhere, U.S. News, CNN, Bigger Pockets. But he's getting good results. He had told me earlier before we got going that he's helped his clients increase their personal cash flow over $300 million. So he's getting it done. And it's interesting. A lot of people, they just, they aren't really talking about cash flow. And that's another thing that I thought was interesting, where usually you just hear about building a nest egg and that kind of thing. But then when you go retire, it's like, what's the plan? So anyways, welcome, Chris.
Hey, it's a pleasure to be on, man.
Yeah. So how'd you kind of get started doing what you're doing and maybe just bring us current to today?
Yeah, well, it definitely wasn't my original career choice. I was planning to become a business consultant, but I changed direction a little bit. To go back, I was raised by parents that taught me good values. My dad taught me that your word is your bond. My mom taught me that, it's, you follow your heart and your passions and you leave a legacy. But the one thing they didn't teach me about was money, right? They were the typical Americans that, my dad was like the save it forever kind of guy. He was like Dave Ramsey's older brother and Dave Ramsey looked up to, he was the nice penny pinching miser. He saved everything. He didn't want to spend money. He paid off his debt, all that kind of stuff, right? But it was always a life of lack for us. It was always like, we can't afford this. What do you think I am, made of money? Money doesn't grow on trees, all those kind of common phrases you hear growing up. And at least it was for me. And the worst one for my dad was, I'm going to work until I'm dead. Like, my job will literally kill me. And I vowed I didn't want to follow that path. And so when I went to college, like I said, I want to become a business consultant. So I dropped out of college to get real life business experience. Because I thought, I don't want to just have an MBA. I want to have experience to go with that MBA. So I dropped out, just supposed to be a 1-year sabbatical. I was trying to figure out what business to start. And the one that came up eventually that intrigued me was a financial advisor position. And I thought, well, this could be fun. I don't know much about money. I'd like to know more, and maybe it'll help my dad get his life back. And what was interesting is that I didn't realize it was so easy to get in. You just had to pass a test with 70% and not have a criminal record, and you could become a financial advisor. But I thought you had to really audition for that thing, So I was like, almost like trying to boiler room it, But anyways, eventually, I started to do that path. It was commission-only type of advisor services, and I liked it. I actually liked being an entrepreneur and being on my own. And then after a few years or so of being in that business, my dad said, well, when are you going to advise me? And that was probably the most nerve-wracking meeting I ever had. It doesn't matter how much money other people had that was, could make me nervous. It was nerve-wracking because this was my dad, right? And of course, he's very opinionated, very bold in how he speaks, way more bold than I am. And of course, he's the guy that changed my diapers. Right. So it was a little bit intimidating going in, but as I sat down, looked at his finances, which he never talked about growing up, at least other than saying he doesn't have money. I'm looking at all of the money, right, that he never would show us. And as I'm looking at it, he's packing money in his 401k. He had paid off his house early. He was debt free, totally proud of that. And I said, all right, Dad, here's the deal. If you want to retire today, even though you're 61 years old, you would have to hopefully die in 5 years, because that's how long your money will have before it runs out. He said, all right, Chris, that's not what I want to hear. I said, I don't know what to tell you. He's like, all right, well, what could I be doing? What else should I do? Like, what else do you have for me? I was like, I don't. You did everything right. You did everything that all of us as financial advisors told you to do, and yet it's not enough. And that bugged me. It really bugged me, because remember, he was kind of the inspiration that helped me get into this business, and now I can't even help him. And it was interesting, because then one of my friends who was a financial advisor, I actually hired him as a financial advisor in my firm, and then he left to go do real estate investing. And I thought, oh, good luck with that. Well, I talked to him just 4 months later, and he and his dad are partnering on some deals. They're actively flipping properties and double his dad's income as a professor at the local university. And I thought, okay, that's too good to be true. No way. Stocks are still better than real estate. It's historically proven that you put $1 in stocks in 1926, it'll be $56,000 today, right? And all that kind of junk, And he's like, Chris, how many of your clients are truly financially free where they don't worry about money? And I said, oh, well, you put it that way, even the clients that are retired, they still worry about not having enough money when they die. So none of them were that free. Okay, Chris, good job. Well, how about this, Chris? How many of you guys as financial advisors are free, not off the commissions you're earning, but actually being in these mutual fund investments? And as I thought about it, I thought, well, let me think. And I remember I'd been in that office for 4 years. There's 100 people in that office. And there's guys that have been working there since the late 1970s. And yet they still couldn't retire. And this is, of course, the mid 2000s, right? This is about the time you had your internet business, So, yeah. So I'm like, no, maybe none of them. He said, there's your problem, Chris. Okay, well, give me the answer, Doug. His name was Doug. He's like, I'm not going to give you the answer because you just got done telling me that stocks are better than real estate. I said, listen, I get what you're saying. I'm open. Give me something. And so he had me read the book, the book by Robert Kiyosaki, not Rich Dad, Poor Dad. It's actually called Who Took My Money, right? Basically, if you were to save you the 3 hours of an audiobook, mutual funds suck is the point of the book, right? And then he had me listen to this AM talk radio show that was local here in Utah that had these two real estate investors talking. And I got into it. I got sucked into it. And a matter of a few months later, I had this integrity crisis. I now knew something was better than what I was teaching. Because the truth is, the results from financial advising wasn't working. People were not becoming financially free. And it was becoming, in my mind, proven. Evidence was overly abundant that people could not retire, paying off their debt, and saving in mutual funds. It's just not enough. There's not enough return in the market, and you can't live on enough to make sure that the money doesn't run out. But then I seen this other path of cash flow and passive income. That path worked. That was proven. There's people actually financially independent, sometimes in their 20s, 30s, or 40s, actually financially independent. And so I had to make a choice. Either I stay in my current path as a financial advisor, which I was already questioning anyways, or I keep my integrity intact and leave. And so I chose the latter. I said, you know what? I'm done with financial advising. Never do it again. I'm just going to go be a mortgage broker, do a little bit of stock coaching on the side, and teach ballroom dancing as well on the side. And that's what I started doing.
It's quite the mix.
It's definitely. I'm kind of a Renaissance man.
Yeah, that's so interesting, and just kind of the way your dad thought about money and talked about money. That's exactly how my grandpa was. Mm-hmm. So my mom's dad, and is where he had done what everyone told him to do. Just worked. He worked at the same company. I understand it is his entire career, like a 40+ year career, and the only reason that worked back in the day was he had a pension. But he did all the stuff you're talking about, but on top of it, he had a pension. So then he ended up being okay because of that. But if someone would have opened up the kimono on his finances, I mean, he taught me when I was a kid, because I was interested in money. I'd ask him what he was investing in and go to the bank with him. And he was investing in, I don't even know what they're exactly called, but the bonds where you get them physically, whatever those are. So you don't even trust the bond market. He literally kept them in his home. And they're like physically redeemable. So if, the bank goes under, that's like, you're still protected kind of mentality. So, Yeah, that's so I know what you're saying. And then yeah, and someone like that, if he didn't have a pension, his income was never high enough to save as much money as he would need to be living off 1% and 2% kind of stock dividend, or 2% and 3%, 4% bond yields like that. You're never gonna save enough doing that. And yeah, I totally hear what you're saying. Then once you realize that, it's like you feel like you're shelling out bad advice, and this is like not somewhere I'd want to be either. So
Yeah.
to finish the thought, were those products also like commissions, where they were sometimes loaded products too, and all that, or how were you even getting paid as a financial advisor?
Yeah, it was all commission based. Yeah, so it was. I mean, they all had their different commissions and different loads and things like that. I mean, there's like annuities, right? There's different types of mutual funds. Even the different types of funds would pay you differently. Like if I put somebody in a money market, I got paid almost nothing, because they got
Right.
paid nothing. But there are more mutual funds. You could do front loaded, back loaded, mix between, all that kind of stuff. That we did, even insurances that we did as well. Usually was stock market based type insurances like variable universal life instead of the typical, like I poo-pooed all over whole life, even though I never knew what it looked like. I was just like, oh, whole life sucks. Why? Because that's what everybody in my office told me.
Yeah,
You know?
and were you guys selling whole life? No, it was probably
Oh
you guys
no,
had
no,
term or
we didn't
something,
sell whole
right?
life at all. We just we sold like stuff that's mostly stock market based. What really woke me up, right, in that industry was that I was really just a salesman in a suit, because all the education that you're taught as a financial advisor comes from the companies you sell for, right? And they're coming across as like, hey, we're going to teach you about this, and here's some great strategies to help your clients. But in truth, all you're doing is you're being trained to sell the clients that one thing. And if you look at the media and everything else around, because people say, well, what real estate investing? Why don't I hear more people talk about that? Well, because there's not a big commission based on that. That's why. Because every financial institution's selling you stuff. In fact, look at the two big things you're told to do in the accumulation theory, as I call it, right? Where you're taught to accumulate net worth, save up as much as you can in your mutual funds while paying down your debt. Both those strategies, ironically, isn't it funny that saving up in those mutual funds, that's how the companies like your Goldman Sachs, your Merrill Lynch's, all those companies, right? Fidelity, they all get paid off of those load fees. They get paid their fees whether you make money or not in the market. So they make money by you keeping your money there, that miracle of compounding interest, and let it keep growing and pull out less than the interest when you retire. And then they also tell you on the other side, pay off your mortgage, which puts the banks at less risk too, which just puts more money in the bank's hands, right? I used to think that having a mortgage was what was making the bank more money. And yes, of course, when they loan out money, they make money. But the truth is, the faster you pay back those loans, the more money they can lend out again. They keep getting that flow, or I call the acceleration of money, right? They're constantly flowing money through to accelerate and create more speed. And we're just told, hey, set it and forget it. Pay off your house, be debt free, and then of course the banks are fine. Or keep paying down that house, accelerated payment for a while. Those things are the very things that make banks and financial institutions more money. Isn't it funny that that's what all the educations teach us to do in the financial world? And that's why, because they are the ones giving the education, pass on through financial advisors and financial experts, the talking heads on TV, to then pass on to you to say that's what's conventional wisdom. No, it's not. It's what's conventional sales for them.
Yeah, I've realized the same. Where you realize that when you talk to your any life insurance agent or person, right, a financial advisor, when you really look at what are they offering you or selling, I am a big fan of mutual funds. It would be their response. And like, why is that? Like, that's what I'm offering. Doesn't going into low fee ETFs that you can just buy on your own wouldn't be helping them any, given that advice. But so yeah, I've saw that too. And I tell people that are new in real estate, there's a similar sort of parallel with real estate brokers, where sometimes new investors get frustrated with the brokers, where they're like, I ask them what they think of it, they always say it's good and this and that, and like there's just everything's so positive, and it's hard to like actually talk to them and this and that. And it's like they're in a sales role. Their job isn't to tell you don't buy my deal. It's to say here's what's good about it and why I like it. It's up to you as the buyer to figure out if that matches for you and what you don't like about it or what the problems are. And so same thing with investing in anything really. But that's sort of the real estate parallel, where I hear new people kind of, frustrated with that, where they're like, and it's, yeah, their job is to sell the deal, not to explain what's wrong with it,
Yeah.
So that's interesting. Well, yeah. So then where did, actually a mutual fund question before we go into what was next. At this point for mutual funds, you were selling offering loaded mutual funds. I know, and their sort of pitch on that is the annual fee, the management fee should be lower because there's a load. Do you even agree with that at this point with all the additional knowledge you've obtained, or what would you say about loaded mutual funds?
It's no unknown statistic, of course. It's pretty commonly known that over 90% of mutual funds don't even keep up with the S&P 500. And that's true. And that's not just the typical mutual funds that you might buy from an advisor. That's even true with your 401k. In fact, more so true with your 401k funds than anything. I'll give you an example. Fidelity just came out with their numbers after the end of 2022. And they said, all right, well, the number of 401k millionaires is shrinking. There are now only 299,000 people with 401k balances over $1 million in Fidelity. And that's with tens of millions of clients, right? One, that's of course just proof that it doesn't work. But two, what's interesting is that they also released and actually you don't even have to wait for the report. You can actually just go online to Fidelity's website, see what their funds actually pay. You can see all their different funds. Most people are told, especially the millennial generation, we're told to just put it in the target date funds. So if your retirement date is supposed to be 2055, you put your money in that 2055 target date retirement fund, right? It's so easy. Like, oh, I just have to pick the day I want to retire, and that's it. What's interesting, though, is I ran the numbers. The S&P 500's real return in the last 10 years, and just so you know, the average return that they tell you is different than the actual return of the stock market. And I say that because if you've ever heard these numbers before where average and actual are different, for example, let's just say you have $100,000 and the market tanks 50%, you're down to $50,000. Now, it's funny because I remember a guy came to train our office when I was a financial advisor to teach us this. And he said to every financial advisor in the room, there's a lot of us, there's over 50 of us in the room in this training. And he said, okay, guys, so you just lost $50,000, you lost 50%. What's the return you need to make to get back to 100,000? And we all said 50%. He said, no, guys, it's not. Because 50% of 50,000 only gets you 25,000 more to 75,000. You're not there yet. He said, guys, you need 100% return. So he wrote the numbers. He said 100% minus 50 equals 50 divided by 2 years. He's like, guess what? Even though your actual return, if you actually did this, got back to 0% return, your average return is actually 25%. Because 50% divided by 2 years is 25%. But your actual yield was only 0. And of course, if you were being honest, if there was those load fees, it probably would be more like around $96,000, $97,000, right? But he brought that point up. He's like, average and actual are not the same. And that blew our minds as financial advisors, like, what? And so I started actually looking at the S&P 500. Did you know that the 30-year average of the S&P 500 is actually, as of 2 weeks ago, and it depends on the day, of course, but it's usually pretty close to this number. It was 7.65%. Not 10, not 12, 7.65%. And remember, 90% plus of mutual funds never even hit what the S&P 500 does. So I'm more of the opinion that an index is better, but I don't think it's the answer. It's not enough because even Fidelity, people that are saving 401ks getting their match, they think the match is going to make them 100% return or 50% return. That's not true either. Put 100% return with, say you're saving $10,000 a year in a 401k, put 100% return for 20 years and watch what that number does. You'll be richer than Bezos. Okay? Right. In 20 years.
Yeah, it's 100% one-time match. Yeah.
Yeah, it's a one-time match. And so all it does long-term, if you talk about the Rule 72, it only adds about a 2 or 3% return long-term at most. If you're max funding your 401k, it's a lesser return because you're putting more in than what you get for the match. So what happens though is that Fidelity, going back to this example, right? I looked up their funds for the last 10 years. Those target date funds hit about 8%, almost exactly 8%. That's before the 0.75% comes out. So it's really about 7.25% they made. But the S&P for the last 10 years, that actual yield was 10.1. So
really,
think about it. The target date retirement funds that everybody's saying, oh, that's good, I'm in the market. You made almost 3% less than what the market actually did. So going back to that 7.65%, well, what if 7.65% is that number? And let's just say I make it a little less than 3% still, right? You extrapolate that and say, well, what if it's the same spread? Well, guess what? You didn't make 7.65. Now you're making about a little less than 3% less than that. That's about 4.75%, right? You're now not even making 5%, which goes more true when you hear people that have been in 401ks for a while saying, wait a minute, like my returns are not that good. So even with the match, yeah, you got another 2% back. Okay, yeah, you got 7% maybe, 8% if you're lucky. And then you get taxed on all that too. So it's a sham. I think it's one of the biggest, crappiest type of Ponzi schemes ever is the 401k. I think it's a dumb thing to do when you see the reality. And this is coming from a guy who used to tell people, load up money in your 401ks, right? But when I started to see the truth, that's when I realized real estate, you have way better odds of success in real estate. And you mentioned that on my podcast too.
Right. And how did the 10% turn to 7 and then to 4? I was with you on the average, the difference where you average things, because in like private equity or what we do, like we would have calculated a compounded annual growth rate, which my understanding is then that isn't, it's not taking a simple average. So then it's interesting, any sort of like real data source, if you're like, what was the rent growth in this market the last 10 years? They wouldn't tell you the average. They would tell you a compounded annual growth rate. Or what you should do probably is just download the raw data and then calculate it yourself, which is what we do. But how did the 10 turn into 7? Where at that point you had lost me in this, because I was with you where it averages out, you get a little lower. But how did the S&P actually make 10 and then the fund made 7?
Yeah, we almost need a whiteboard, don't we?
I mean, I thought it was because it was partially in bonds or something, because you need to get you going in bonds a little bit early or something silly, but didn't sound like that.
There's those ones. Those are like the target date 2025, 2030. Those ones have a little bit more heavy in bonds. So I was more quoting the ones that are longer term, the ones they pretty much just put in equities, and so those target date funds. So yeah, the 10.1%, that's the SP 500. That's if you were to take the SP 500 of the end of March of 2013 to the end of March of 2023, right? So that 10-year period. Mm-hmm. If you were to take the SP price compared to the price today and you put it into a compound interest calculator, you'll find out that the average compounding return was 10.1%. So not a total return, obviously. That's average per year, like an actual yield, So that's the problem, is that a lot of times people say, oh, it's average this. But the averages, you put in the calculator, it comes out with a very different number than the reality. So we got to put in the actual number that works, right? So 10.1, which is higher than the average of the 7.65 for the last 30 years, the last 10 years has been 10.1 because we had the 2010s, which were just awesome. Well, the Fidelity funds, those longer target date funds that are more equity based, those ones were averaging almost exactly 8%. Even whether it's the 2050, 2055, 2060, they're all pretty much about the same return of about 8% during that same period of time when the market did 10.1.
Yeah, and the reason for that is just because what they had selected as their investments. Now that I would assume. Okay, got it. That's where I was like,
the index, right? They're just
at first I thought that's what we were doing, apples to apples, and I was like, how did they underperform by 3 but it's what they picked? Okay, got it. So right, again, we're paying Fidelity to not beat the market, so good. Then you can pay them extra for that. But that
took away more because there's the load fee, right? The 0.75% fee shows right there next to the fund. That's not included in that 8%. So when you take that 0.75% away, now you're left with about 7.25, 7.3%, while the market did 10.1. So if you had been just in an S&P 500 fund, right, just the ETF, the exchange traded fund, you would have made almost 3% more than having your money with Fidelity.
Interesting. Yeah, I can see that. So then let's hop to what you figured out what you'd want to invest in. So we were mortgage brokering and doing all this other stuff, and then where did you kind of see the light on cash flow?
Yeah, I saw it before I quit being a financial advisor. I spent about 2.5 months trying to make it work. And then I realized I just couldn't do it anymore, right? So I left being a financial advisor, and that's where I was doing mortgages and whatnot. And then at the same time, I was learning about real estate and more of the active, like flipping and things like that. I was doing more active investing, management. I was buying even properties, doing long-term rentals and things like that. And eventually later that year, I was actually able to get out of the rat race myself. Now, granted, my expenses were only $3,500 a month at the time, so it wasn't hard to get out of the rat race. But I mean, I was pretty happy. I was like, wow, I'm 28, almost 29 years old, and I don't even have to do mortgage brokering anymore. I could quit that. I could quit doing stock coaching. I could do whatever I want. And that was a scary place to be because I never expected to be there that quickly, you know? But but that was the thing. Like that revelation was, it was always about cash flow, right? Like what's the actual income or profits coming in? And remember, in that accumulation mindset of as a financial advisor, you just think I got to build up this humongous nest egg and then live on 3% a year. It's funny because a lot of people talk about the FIRE movement, right? The whole 4%, you live on 4%. That was almost debunked 20 years ago when I was a financial advisor. It's now since been debunked a couple years ago by even some of the bigger firms saying, yeah, that 4% rule doesn't work anymore. It should be at most 3%, right? So
interesting.
So if you save up $1 million in your 401k, that means you're living on 3%. That's $30,000 a year before taxes, right? So even then I was thinking 3% back in those days, back around like 2004, 2005, my goal was to have $2 million saved up because I thought I'd be living a very comfortable life at $5,000 a month, right? At $60,000 a year. So I thought, awesome, I just need to save $2 million. And if I scrimp and save, I turn off the AC in the summer, turn off the heat in the winter, and just be as cheap as I possibly can, maybe I can save up enough that by age 40, I'll be financially independent, right? That was my goal. And so all of a sudden, with real estate, the big shift for me was, I mean, just using easy numbers, right? Like if I could, put $100,000, earn 1% a month or 12% a year, that's $1,000 a month. That's way better than $3,000 a year from a retirement plan, right? That's 4 times better. So I was in this place of almost like euphoria when I realized what you could do with real estate, because I'm like, wait a minute, all these people that I'm telling, oh, you're gonna have to delay retirement, you have to push it off forever, telling them to do that versus, wait a minute, you've got $500,000. If we made just 12%, that's it's $5,000 a month. You could be financially independent today, potentially, depending on their expenses, right? At that time, 20 years ago, before inflation, you could be financially independent. Now, almost everybody says they need like $10,000 a month, typically, is what I hear. 10, 20, 30,000 a month is typical for our clients. But, still, it's like, you got $1 million, let's make it work. I had one guy on my podcast, he was a client of ours, or is a client of ours, and he had $1 million in his retirement plan. He happened to save it up just right. In fact, he even moved his money away from stocks right before Y2K crashed. Then he moved his money away from stocks right before the Great Recession. Like this guy did everything timing-wise perfectly.
Yeah, what's he doing
better
right
than
now?
American, right?
Yeah, Chris, and, what's that guy doing right now? We need to know. So
now he's retired. Yeah.
Well, with his money, if he's predicting, is he in cash, stocks, real estate? Where is he at?
Well, yeah, when we worked with him, we got him diversified a little bit. So he got a few like turnkey duplexes and things like that, just to kind of diversify a bit. Put a lot of money in like oil and gas space, specifically with like royalties, mineral rights, things like that, where you get paid on the rent of the land and you get paid on the drilling too, on the actual profits from that. He's done some of that. And then he's also in some syndications, like apartment syndications and whatnot. Cool thing is that $1 million, instead of living on $30,000 a year, like his financial advisor actually recommended before he came to us, he's now living on about $11,000 a month. So now it's working much better. And he's at that point, he's just doing contract work right now. He's like, yeah, I'm working a little bit here or there, just for fun, builds up my portfolio a little bit more when I get that extra cash. But he's legitimately now retired.
Nice. Yeah, that's great. So then what sort of stuff let's get into what you do with your clients. What sort of things would you, so let's say I'm listening, I like what we're saying. What sort of stuff are you recommending clients invest in? How do you look at it?
Yeah, we do primarily 2 things in our business. We do passive income consulting. We're not financial advisors. We're not investment advisors. I dropped those licenses back in 2005, right? But we do help guide people along and help them really strategize where to get the money to invest and then connect them with those deals, And then we also do infinite banking, using like life insurance to use that as part of the investment strategy to double dip, to get paid in 2 places at the same time with their investment money. So with that strategy, like the strategy we'll look at is, like I mentioned, like turnkey rentals is one, right? And that can be a good one. I mean, even though the cash flow has not been great lately, there's definitely been better days in the turnkey space. Syndications, like apartment syndications, like we were talking about on my podcast the other day, right? Even like self-storage or commercial and things like that. Heck, even syndications in the business world, although that's a little bit more speculative, like we have people that, we have connections that sometimes will do like a car wash type of business, and there could be profits from that. We've got stuff like I mentioned, the oil and gas space or mineral rights, things there. That's been very popular with our clients. Even raw land, there's even things you could do there with business partnerships that way. That's actually been my favorite investment recently for myself personally. That's been paying off about a 45% return, cash on cash.
And what kind of land is this?
Just raw land. Just like, yeah, it could be for development. Sometimes it's just like raw land, like, next to ranches. It could be land that's, recreational land or whatever it might be. But we're just doing seller financing. So cool thing is I'm totally passive. I'm letting them, my 30% partners, do all the work, and I'm 70% by financing it all. But so that's the good news. But it's been a great partnership that way, because we buy the land and usually sell it for at least double or triple the price, and then we sell it on terms for the next 5 or 10 years. It creates amazing cash flow off of that. So.
Yeah, I heard somebody on a podcast, I think it was probably a different guy, talking about the same business, but he was saying why he's done with seller financing too. As something I forgot the reason, but it sounded like a nice business. And they were specializing in like smaller land pieces. Like when he was talking initially, I thought he's buying like huge sites for $10 million and turning them into neighborhoods. And it was like, no, I just know what it's worth, and it's hard to sell these. So, sometimes, so then, we're just buying low and selling high, like it's simple. So,
yeah. Those land parcels, when you buy them wholesale, or buy them at our price, it might be anywhere from like $700, all the way up to maybe 10, 15 grand, for that lot. So it depends on the property, but yeah, it's pretty cheap. It's not like buying like huge, it's not like we're buying in California or anything like that,
Right.
But yeah, those have been great. Even like lending has been good. Especially lately with how things have been, like the equity play, as you well know, the equity play has been a little bit tougher to find deals, but on the debt side, if someone's borrowing money to renovate or even just to, build to rent or whatever it might be, or even just in general, that's been relatively good too. Just, whether it's short-term lending or even just long-term debt funds, that do lending as well. Those have been pretty good too. So there's a lot of variety that we do. And of course, depending on the markets, like apartment space has been a lot tougher to find deals. So we haven't had as many of those in our group with all of our we have like over 20 different investment providers in our group. So, but a lot of times when that comes back, then that comes roaring back as well. And there's plenty of opportunities there too.
Yeah. Today, if you're looking just for cash flow, I would think real estate syndications or buying turnkey deals, which if no one's heard the term turnkey, that's you're buying a fully renovated property and renting it out. Like you're the direct owner. You're, ideally you hire out the property management. So it's not that work intensive, but you're the owner and the asset manager. But the cash flow is very compressed. A lot of these deals, if they had no debt in them, would make 5 or 6%, but those are what the rates are to borrow. So you're not generating a lot of positive leverage from a cash flow standpoint. Obviously that'll change. Rents are going to go up, and then you'll be in at a higher cap rate, higher yield on cost. And then, most people would think rates are going to come down as well. So you'll be in a good spot. But yeah, if you want cash flow today, just from what I see in the real estate space, I'd be curious if there's something higher in those other niches you were talking about. But it would definitely be those sort of, I'll use the term hard money loans, where you can still come in a first mortgage position, but it's like someone's going to renovate a house. They want to do it fast and not have a lot of hoops to jump through like a bank, and you could charge 8-9% on up on that. So the yield's a lot higher than what you get buying an apartment building or something today, or investing in a storage deal like what you're talking about. But you have capped upside. Obviously, best case is you just get paid all your interest and paid back. But I think that makes a lot of sense if your number one thing is I'm focused on cash flow. If you're focused on total return, I still think just more traditional syndications and owning property outright is going to do better than that. But the cash flow could be like half of that amount we were saying.
Exactly.
Anything beating that 8-9% percent? Like is oil and gas or what were those
oil
kind
and
of
gas have been,
yields?
they target at least 10 to 15, but they usually do 15 plus. I mean, now one fund I'm in, like I'm in one of the deals I'm in, it's only been about 8%, but that's because only 25% of it's even operating. You know, we haven't even done the other 75% yet. So it was like 8% last year. But the fund that came out just a month after I got in, the next one that came in, that's several of my clients got into, got paid 35% in the last year. So
Wow,
it's kind of,
and that's in,
so that's why
in
some
a
of them will,
dividend.
like, put into multiple deals just to spread out to see if they get different returns,
Yeah, and that's you're saying 35%, as dividends or cash flow in a year on that deal.
Yeah, exactly.
Nice. And
Yeah,
then
so
where would you put that on the risk spectrum then? So obviously like lending would be the safest, and probably from the stuff you talked about would seem like being in like an apartment deal either on your own or in a syndication seems like the next safest. Then how's the rest of that stuff stack up? Like a risk
Yeah, it
standpoint.
depends on how you view it, right? Like I definitely look at equity. I mean, even though equity from a cash flow standpoint may not be the best right now, I still look at it as being safest, having ownership in certain things. Like even a turnkey property, right, where I'm not property managing, the cash flow may or may not be, fantastic. I'm seeing right now at least 5 or 10% cash on cash returns. So there's still some that are even 10% plus on occasion, right? But but at least I know I own it, I control it, it's safer, and it's still cash flowing. But definitely, I see more opportunity in lending. That mineral rights space has been really good, especially because oil is still suppressed in price right now. I mean, imagine what that would do if it starts to go up to 90 or $100 a barrel versus 70 or so. It's even a more profitable venture. Land has been great too. So really, I guess my big focus, other than like the lending aspect, I mean, I've really been kind of more bullish on having that ownership and control, having real asset-backed investments, like that kind of thing. I think that's really been the ones I've seen. And even like self-storage, like I've seen that the cap rates are shifting on that a little bit. Like unlike apartment space where people are still saying, I want more money, self-storage are starting, in certain areas, they're starting to say, okay, I'm getting more realistic. And so I'm starting to see a little trend of that starting to come back as well, which that could be another great opportunity too.
Yeah, storage got so hot where there was some index where it was like, I think for REITs, where it was like how far above the historical average it is for either the cap rate or the prices, and the storage was the most out of whack, like in terms of like going for like 200% more than normal or 100% more.
Oh yeah.
And apartments were only like 30% on that scale, and then industrial was also like really high. For being like, and so I mean, I think that's might be just kind of reverting more to the mean. I mean, there was a while where like the lowest cap rates you'd see on anything were in self storage, and that's kind of surprising. But it has a whole recession resistant pitch and everything, and that seems to be proven out in the data too. So
yeah, it was interesting. I was talking with an investor. I was asking him about how his market was looking, and he's out in Iowa, right? And he'll do stuff more in the Midwest. And he said that in August of 2022, for example, one property he's looking at for that self-storage facility was 1.65 million was the asking price. And he's like, that's just too rich. It's too high. 4 months later, December of 2022, he asked the same guy, and that guy lowers his price to 1.15 million. So he dropped it about $500,000 more just because, those cap rates are shifting. They stopped expecting a higher price because nobody was buying it. It was just too overpriced. And so he's starting to see those prices come back down a little bit. Now, I talked to another self-storage operator, and he's saying, no, it's still hot. Like I'm still having a hard time buying good value. I think it just depends on the markets you're in.
Yeah, probably depends on the underlying fundamentals. Like the guy who cut his price to $500,000. I mean, all these leases are month to month. Maybe he had a ton of people move out and he's re-renting for less, going, geez, I'll never get 165. I better get more realistic. This has always been like $1 million deal this whole time. And I could only get that super high rent on like 1 or 2 units, and those days are done.
Right. Exactly.
Nice. Well, cool. Yeah, let's leave it there. I mean, so then, Chris, how do people get in touch with you? I mean, they want to learn more or work with you. I mean, what's the best way to do that?
Yeah, you can always go to moneyripples.com. And then also you can follow our podcast, the Money Ripples podcast, on YouTube or any podcast, like Apple Podcasts or anywhere else you listen to podcasts.
Cool. Perfect. Well, yeah, thanks for being on. Good conversation. Appreciate it.
Yeah, same here. Appreciate it, Drew.
All right. Thanks for joining us, and we'll see you on the next episode.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Brenneman Capital's website, brenneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Brenneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.